Even the greatest investor of all time made mistakes that cost billions, and beginners repeat them every day. Warren Buffett is often seen as the gold standard of investing, but what most people don't realize is that many of his biggest lessons came from painful mistakes, not from his wins. Today, we're going to break down Buffett's biggest investing mistakes and, more importantly, what you should do differently as a beginner. Now, to be clear, this isn't about stock tips and it's not about flexing with hindsight. We're only focused on timeless principles you can actually apply. All right, mistake number one, waiting too long to buy great businesses. For years, Buffett famously avoided investing in companies like Google and Amazon. He watched them from the sidelines. He later admitted he just completely underestimated their business models, how dominant their competitive advantages would become. He didn't fully understand them at first, so he didn't act. And that inaction cost Berkshire Hathaway hundreds of billions of dollars in potential gains. The lesson here is brutal. Waiting for perfection can be far more expensive than acting early. So what does this mean for you as a beginner? It means you shouldn't wait for the perfect entry into the market. You shouldn't sit on the sidelines with your cash, waiting for the next crash or for a stock to hit some magic number. If you're just starting out, buying a broad market index fund that tracks the whole market is almost always a better move than waiting, because the old saying is true. Time in the market is infinitely more powerful than trying to time the market. The second mistake is the flip side of the first one, holding on to losing ideas for far too long. Buffett has been very open about this, admitting that he's held on to certain investments long after he should have sold. It's loyalty to an idea, an emotional attachment that can blind even the most brilliant investors. It shows that being patient is a virtue in investing, but being stubborn is expensive. So here's the incredibly simple, actionable way to avoid this. Before you invest a single dollar in a company, take out a notepad or open a file on your computer and write down two things. First, why did I buy this? Be specific. Second, what would have to happen for me to sell this? This could be the company losing its market share, the CEO leaving, or the debt getting too high. Then, if that thing you wrote down actually happens, you have to reassess. You have your own logic written in your own hand telling you it's time to look again. This simple exercise separates your emotions from the decision. It's pure gold for a beginner. Mistake number three, avoiding technology for too long. Now, this one is nuanced. For decades, Buffett avoided technology because it was outside what he called his circle of competence. He didn't understand it, so he stayed away. And in many ways, that was rational. It was disciplined. But it was also incredibly costly. He missed the biggest wealth creation engine of the last 30 years. The lesson here isn't don't be disciplined, it's this. Avoiding what you don't understand is smart, but refusing to learn isn't. So as a new investor, don't just blindly copy Buffett's old avoidance of tech. Instead, take a different approach. First, take the time to learn. Read, listen, understand the basics of the sectors that are shaping our future. And if you want exposure without having to become an expert overnight, use tools like ETFs, exchange-traded funds. An ETF can give you a small piece of the entire tech sector, so you're not betting on one single company, but on the trend itself. It's a way to participate safely while you're still learning. If learning from real investing mistakes like these is useful to you, this channel breaks down investing without the usual hype or shortcuts. You might want to stick around. Okay, on to mistake number four, and this is a big one for anyone who tries to copy Buffett directly, believing that concentration can't backfire. Buffett is a huge believer in concentration, putting large amounts of money into just a few companies he knows inside and out. But here's the catch, that only works when you have decades of deep, world-class expertise. For everyone else, it's a recipe for disaster. This leads to a critical rule. Concentration builds wealth for experts, but diversification is what protects beginners. So what do? The answer is simple. As a beginner, you diversify. You use tools like broad market index funds to own a tiny piece of hundreds or thousands of companies. This spreads your risk. The time for making concentrated bets, if it ever comes, is much, much later in your investing journey, not at the start. Don't copy the portfolio of a master until you've mastered the basics. The fifth and final mistake is perhaps the most human one, underestimating the power of emotional bias. Even Warren Buffett, the icon of rational investing, admits that emotions like fear, pride, and attachment can influence decisions. They affect everyone from the first-time investor to the billionaire. Because the single biggest risk in investing isn't a market crash, it's your own behavior. It's selling in a panic or buying into hype. So the most powerful thing you can do is build a system that protects you from yourself. How? First, automate your investing. Set up automatic transfers every week or every month. Second, invest consistently, whether the market is up or down. Just stick to the schedule. And third, stop reacting to the news. Tune out the daily noise and focus on your long-term plan. This is how you win the behavioral game. So let's pull it all together. 5 mistakes from the master that we can learn from. Waiting too long means you miss out on growth. Holding on with stubbornness leads to bigger losses. Refusing to learn about new things has a massive opportunity cost. Copying an expert strategy without their expertise is dangerous. And finally, letting your emotions drive the bus is the silent killer of returns. The most important thing to understand about Warren Buffett is this. He succeeded because he didn't avoid mistakes. Nobody does. He succeeded because he learned from them, adapted, and above all, he stayed disciplined for decades. The goal isn't to be perfect. The goal is to stay invested long enough to win.